far as getting loans done, I haven't seen any issues. It's business as usual. What I think the most important thing for your agents to kind of know at this point is that every lender and every correspondent and every bank is handling this in a different way. They all have different appetites. Some are closing, some are on the sideline, some are just kind of waiting, and some are aggressively making changes. And I think what's most important for your agents is not to take everything that their mortgage person tells them at face value. And I'm going to give you an example. There's two types of loan officers, Al, right? There's the loan officer that you call them, they have 20 products. The truth is the right product might be the 21st product that they just don't have at this time. And rather than telling the client, listen, I don't have the right product for you, but it does exist, and it may be in this place, I tell the client I can't help you right now. That client then calls your agent and says, well, I spoke to the mortgage guy, can't do a loan for $650 with 10% down. Meanwhile, they just went to a loan officer whose company at that particular time may be a little bit conservative with that product. So what I want your employees to know, or the realtors, you know, at this time, I'm around and I'm happy to help and talk to any of you guys if you have deals. If you think your loan officer that you're dealing with is telling you something that may not make sense, they just might be uncomfortable with telling you, hey, tell your client to go here or tell your client to go there, because they're afraid that you're never going to come back to them. What I found is when I'm honest with my agents and I help them close deals because they need to feed their families right now, they will come back to me if I have the right product whenever they do call. And don't get me wrong, I have the right product for many of things, but there have been a few items along the way where I said, hey, you know what, this might be a better fit for you, and now your Keller Williams agents will close the deal where if they would have went with me, it might not have happened. So I think what's most important right now is honesty, and I think, you know, funny enough, I think I had the best Keller Williams month that I've had so far as purchases coming in since the pandemic. So there are deals coming in from the agents, but just be careful out there, guys, because what you're being told may not necessarily be the truth. And it's not, again, because your loan officer is trying to throw you off. They just, you know, might be insecure, or they might not want to go there, you know? So it depends on who you deal with.
So the message for today is mortgage guys are liars. Is that what we're saying? Sometimes,
yes. No, it's really, again, you know, you call up the NJ lenders of the world or the Atlantics of the world on certain products, and we might be a great fit for that particular product, and they call Chase or Wells Fargo and they might not do it, and vice versa. So you really, you know, you just don't want to check with one, you want to call around and do your research. But I think as agents, it's important for you guys to let your clients know that this is not a normal market, and one shop stops don't do it all. It's important for us to find the right product for what you're doing. You know what I mean? Because they're all different, and it's hard to navigate.
Sure. All right. So anybody, thank you, Adam. Anybody have any questions for Adam? Any mortgage related questions? Come on. Nothing? All right. Adam, I think you said you have to bail. I was going to ask you to hang around. Usually questions come up later. Looks like
I think Anat has one.
Goodbye. Can you hear me?
Yeah,
yes.
Now I can.
A buyer who wants to buy under a trust, revocable trust, can he get a regular mortgage?
I mean, it's a hard question to answer when you only have a little bit of the information. I wouldn't, and I'm not gonna.
It's a purchase for $1.6 million. They will put down. They will take a mortgage of 70%. Financially qualified in terms of income and credit score and all of that, but the principle of the purchase is not under their own name. It's going to be under the trust, the revocable trust. Can they get
and it's revocable or irrevocable?
Yeah, no, a revocable trust.
Which means it could be changed, correct?
Yeah, a revocable trust, yes. But look, I recommended when I had this conversation, I said, buy regular, take the easiest way of a mortgage, then create your trust, right? And, you know, you make revocable, whatever you want, irrevocable. But, you know, they have it in their mind. They want the trust, suppose. So, and
I would tell you all of these more difficult type of deals, even if I knew the answer from 2 months ago, things have changed so dramatically that everything that I say yes to, I really almost have to check because it's changing so much.
How was it 2 months ago? On a regular basis, you know, not a Corona crisis market. Were you able to give mortgages based on when the borrower was a trust?
Yes.
You were. Okay. Thank you.
Question in the chat. Says, what if the mortgage guy tells you they are busy with the loans that people are applying for, so your loan is on the waiting list? Is it feasible?
Say it again?
What if the mortgage guy tells you that they are busy with all the loans people are applying for, so your loan is on the waiting list? Is it feasible?
I've never heard of something like that in my life. Isn't the loan that they're working on for you on one of the ones that they should be working on? I've never heard of that before. If somebody said that, they should go somewhere else for sure.
So, Kat, let me answer that real quick. What I would say to them is they're trying to use a time frame. They're trying to posture up and show that they're busy. So you hit them right back and go, listen, I'd love to work with you. I've got 3 other people in the background that I'm going to go to. Do you want my business? And you throw the posture right back at them. I would listen to our podcast last week we had with Oren Klaff. Amazing. It's about pitch anything. It's about posturing. It's about framing yourself. It's all about sales guides. It's all about creating a pitch. This person is trying to pitch up and posture to you and say, you know what, you're really busy. I respect that. I respect your time, but my time is worth it too. So what can we do to work this thing out? I've got 3 other people in the wings myself. So can you take a look at it for me? If not, Sia would want to be it. That's how I would do it. So sorry.
Yeah, it was amazing too, because he touched on so much that it's always a two-way street. And, you know, even though everyone here is salespeople, you also need to qualify the buyers if they're going to be, or the folks you're working with, if they're going to be a good fit for you. Otherwise, you will completely get steamrolled time and time again. And I think that, to Gino's point, that's a great example of that, because not every time someone comes to work with you are they going to be a good fit. And maybe you don't, necessarily want to work with them, but there's tactful ways to go about that. And Oren addressed that wonderfully in that episode. So.
And Adam's been doing an amazing job of talking about same-side selling. I would look at that book for everybody. Same side selling. You're trying to find impact together. You're trying to work with the seller. If you're a mortgage broker and you have 20 products, listen to what the person that you're trying to serve, what they need, and you're trying to find impact with them. And everyone wants to call it a win-win. But if you can't find impact with them and you can't serve them, it's okay to say that. I can't help you at this particular point in time. I don't have the product. Let me see if I can find somebody. At least try to work with that relationship. And as us as salespeople, we're always trying to sell. We're always, ABC, always be closing. No, it's FIT. It's trying to find impact together with others. And I've learned that through the Jake and Gino community. We're selling education. The education isn't inexpensive. I can't sign everybody up because not everyone's motivated to do multifamily. So we go through a long process. We go through finding out what their goals are. We go through finding out if they want multifamily, why they want multifamily, what their big why is. And then once we know that, we give them some exercises and we bring them through an interview process. So they feel like it's like we're qualifying them. They want to be on our team, but we want them to be on their team also. So if you look at that book, it really exploded my mind because I hated sales, to be honest with you. That used car salesman thing, that's not what the 21st century is. We want to buy. We do not want to be sold. Big, huge difference in my mind. When I figured that out, when I learned that, I was like, wow, there are so many people out there. And us in the 21st century, we have so much information. If Adam is only selling on term and rate and not about a service and not about quality and not about the relationship, you just become a commodity and then it goes to the lowest person. You want to create that relationship, and finding impact together is going to change your business completely. So.
Awesome. Well, thank you for jumping in there, Jake. That's a good segue to turning it over to, looks like I cannot turn it over because Anand has another question.
I'm sorry, if I may ask one more question. So I'm in a deal right now, and the buyer is not my buyer, so he chose his own mortgage lender, Citi, and supposedly was qualified and this and that, and we got a conditional commitment. But then when it came now to the actual closing, so we wanted to remove all the other conditions, and they kept on saying the last part, verification of employment, is still missing, and not everybody's working, and we cannot get them to verify, and the whole thing. And it kept on waiting. Now all of a sudden we hear that he lost his job. So could that be that was not truthful, that the whole verification process should not take so long? He knew that he had problems with his workplace and tried to prolong this. Supposedly now he has a new job that with a little bit lower income, and there is a question if the underwriter are going to approve him with the lower income. He has not asked for a price reduction yet, and he wants to stay into the deal, but there is a question, and he wants an extension. Now, I don't want to give him an extension unless he's going to get himself pre-approved by you, by my in-house lender. I cannot force him to work with you, but I can say, you want an extension, I need to know. And it's not rocket science to run it through underwriters to know if this new income will still justify the...
Why isn't it as simple as him going back to the same city people and saying, my job has changed, here's my new income and pay stub? Why is he...
That's my point. So my question was, there is a continuity in income. It's not that now 6 months he was unemployed. He right away found a new job. He is going to get a new paycheck in 3-4 weeks.
That's
going to be lower. He knows how.
That's fine. So guys, just so you know, with income, you're allowed to change jobs. It's not an issue. You can change a job at any time. If the way you're getting paid is changing, that's an issue. You're going from salary to commission, that's a problem. But you go from a salary job to a salary job, it's not ever an issue. The only time it could be an issue if the new salary isn't enough to cover the new loan. But you're never going to get penalized for moving companies or stepping up or getting a new promotion or anything like that. That's totally fine.
Continuous.
You do have to move over to, or you had another question or not?
No, I'm just saying too, just to clarify, Adam, if it's there is a continuity, yes, that's what you're saying?
No, I'll even put it this way. I just closed a loan for a guy a month ago. He was in college for 4 years. He graduated college. He started a job for 1 month with a salary. I closed him already.
I see.
Salary's king, guys. Salary is the best. If you get salary, you don't have much to worry about. When you start dealing with bonuses and commissions and hourlies, it gets a little trickier when you're switching.
Okay.
All right. Thank you, Adam. Thank you, Anand.
Thanks, guys.
Don't mean to rush you guys. We're spending a lot of money to get Jake and Gino on this call.
Thank you, guys.
They're high. You're welcome. They're highfalutin superstars in the world of.
Al, you're muted.
Did you guys hear any of that?
Heard some of it. I heard we're highfalutin superstars. That's the only thing I heard.
I don't even know what falutin is.
I don't even know what that means. So,
actually, they're the opposite of, and I'll let them get started. They're the opposite of highfalutin. They're literally my favorite real estate podcast and one of the most successful ones out there. The reason I like it, not only do they give great advice and they know what they're talking about, but they're two down-to-earth guys. I don't know what the time frame was, 5 or 8 years ago. Gino was making pizzas and Jake was a farmer rep, so they're not these guys who were kind of born in this business or handed anything at all. The other thing is Jake has a background steeped in coaching. So when you listen to their podcast, it's kind of 50% real estate information and 50% Tony Robbins podcast about getting your mind right and motivation and mindset. So it's called Wheelbarrow Profits. I would highly recommend. It's literally my favorite real estate podcast. And they also do investing, and I've invested with them any opportunity I've had, and it's worked out great every time. So I'm really excited to have them on this podcast. In terms of the format, I think they were kind of going to walk through some stuff and keep it open for questions. Does that sound right, Jake and Gino?
Yep.
Yeah, that's perfect.
The podcast is the Jake and Gino channel. And as you can see behind me, we do 4 shows a week. I have the multifamily zone with me and my wife. We talk about spousal communication, working with your spouse. We have one that's called the Movers and Shakers podcast. We have one that's called Wheelbarrow Profits. And then we have the RAND CRE. So we have a little bit for everybody. And, thanks to Al for opening up and discussing what we do. And I gravitated towards Al, and I look at Al as sort of a mentor for me also, because he's in what we're doing. We wrote the Honeybee, multifaceted multifamily, and the multiple streams of revenue of what we've done. And I was talking to Al when I first met him. I'm like, man, you're doing that in the residential space. You've got a title company, you've got brokers, you've got different streams of revenue. And for me, it was so exciting to connect with him. And I just love talking to Al, and I get excited every time I get on the phone with him. So I share the same sentiments he does.
I have that impact on people, Gino.
I know you do.
Yeah, Al, I really appreciate you having us here. And I hope our goal today is to provide as much value to everyone on the call as possible, because I've been there in a sales position before, and I understand that need to create additional streams of revenue, passive income, and I think the best place to do it is in some form of residential real estate. We're going to talk about recession-resistant multifamily in a little bit here, but I think we're all in a really good spot. And whether you're going to own a few single-family homes yourself, creating that equity and those additional streams of revenue, I think is just paramount to creating a sound, financial future for yourself and your family. And that's what really, this is all about for Gino and myself, was just, taking more control, over our lives and our destiny. Because look, I was, pretty heavily invested in the stock market back in '08 and quickly got sick of it. And, I know some people are probably, taking a haircut right now and riding that roller coaster. So if you're looking for something more recession resistant, more stable, something you can build equity in. And I think most importantly, the sneaky little thing that people don't talk about enough is inflation. And we're going to get into that a little bit, because those printing presses are on, folks. And, don't be surprised if we see $20 and $30 hamburger, in the coming months, because they are letting it rip right now. So the ultimate effect of that is going to be, future inflation. So be on the lookout for that. And the beautiful thing about owning assets is that you can keep pace with that inflation by keeping your rents up to where the market is going. So. All right, getting into the multifamily side a little bit here. The most important thing is that we're talking about a basic human need, and Gino and I joke all the time about the basic human needs. And Gino, they are, drum roll,
food, clothing, and apartments.
Apartments, folks. That's where we're going with it, because look, you're seeing such a demographic shift right now in where society is going. Millennials rent, they move all across the country, and they want flexibility. So we want to be a part of that, and we want to be there to serve these folks. And that's one of the reasons that we love multifamily so much. I don't want to say the word proof. I don't want to say recession proof, because look, there's going to be people that are hurt from this Corona thing that own apartments. I think the folks that manage well, the folks that manage right, are going to come out on top. But you're basically buying to something that is a basic human need. People are renting more than ever, and we're inserting ourselves to serve these folks right now. And that's why we're so bullish on multifamily. I also do believe that in the months to come, people are going to still feel the sting of the stock market, and we could see even higher demand for multifamily. And I know a lot of folks are looking for deals right now. They may come, and I think they will come, for the folks that do not manage their properties well or have been over-levered. But I do also believe that there's going to be a higher demand in the future, because people are going to be trying to offset inflation. People are going to be looking to get out of the stock market, so you're going to see an even larger demand. We've seen it in the family office space, where the amount of money in the family offices historically was much less and has creeped up 5 to 10% over the last few years of their portfolio moving into these types of asset classes.
So, Jake, there's a couple things I want to really hit on. The first thing is, I'm a New Yorker, former New Yorker. I moved to Florida 3 years ago, so I can say this. We live in a bubble up in New York, New Jersey, and Connecticut. It's a bubble because you don't see what's going on in the rest of the world. There's 72 million millennials and 72 million baby boomers, and they are renting. They are the renters of the world. Homeownership is at a 50-year low. Come down to the Southeast, there is a huge boom in apartments because millennials have a $1.6 trillion in student debt. They're not buying homes. They're not like Gino, who has 6 kids, who has to have a big house. They're putting off home ownership because they are getting married later. They have all this debt. And you know what, frankly, it's not what it was back pre 2007, 08. You know, you're buying a house right now, you're buying it at the top of the market. So these people are not buying homes, and we're seeing this. And I know this with certainty because our rent growth has been what, Jake, 4% plus over the last 5 or 6 years. So
Many
what does that
times
mean?
higher than that, Gino.
It means there's not enough supply in Knoxville and in the Southeast, and the demand is pushing up rents. So when we got in this space, to give you an idea, in 2013 in Knoxville, I didn't even know where Knoxville was when we bought our first deal 18 months ago. I had no idea. Jake's like, I'm going to Knoxville. I said, where? He said, Knoxville. I said, okay, you know, let's go look at some deals.
No, I think he said Nashville, but that's another whole other story. So
I went there. That is funny, isn't it? I went there and I'm like, some great deals. It took us 18 months. We were buying 1-bedroom apartment units they were renting at $375 a month for a 1-bedroom apartment down there. Okay. And I was like, this is really expensive. But the moral of the story is the rents today are over 600. So take a look at that inflation and what's happened with the valuations, because there's a lot of demand, and that demand is going to continue because when we go into recessions, people don't have down payments for houses. People aren't going to qualify. So they're going to start renting. And that's the whole idea with multifamily. And the other thing we need to look at is, where is the flow of money? Right now, the flow of money is not in commodities. Doesn't seem like it's in commodities right now. It is continuing to flow in multifamily. And where is it coming from? It's coming from overseas. It's coming from money that's in 1031. 1031 money was huge. They were taking those capital gains, deferring them, and overpaying on multifamily. And that's what was happening with cap rates. Cap rates were dropping because they were overpaying for these assets because, you know what? They wanted to defer capital gains. And everyone else, take a look at cost segregation. Cost segregation is another, you know, macro accelerated cost recovery system. It's another vehicle or another tool that multifamily owners use to defer or to pay less taxes. So there was a lot of things going on in multifamily, why it was pushing the asset class up. And then you put the demographics in there. That's just like adding fuel to the fire with multifamily.
Yeah, I think one thing that's interesting too, I don't know if folks out there have seen the Wall Street Journal article, but for everybody that's in Jersey right now, I would get ready because, you know, the folks that are going to be leaving the city, these high dense urban areas, you guys are in such a great position to serve these folks right now. And what we love about this vehicle, and that's why we keep coming back to, is that finding the basic human need, picking the right vehicle. You guys are, I think, in the next 12 months are having a great opportunity to make a lot of money from the people moving out of the dense areas and moving a little bit more into the suburbs and whatnot, selling those homes and then picking the right vehicle and then taking the excess proceeds, putting them into the right investment vehicle, which in our opinion is multifamily. So you're able to serve the folks that are going to be, moving out of the more dense areas. There's going to be a higher demand, and then those excess, sales that you have and the money and the commissions that you make, this would be a great time to start building those future nest eggs and putting your money to work. So that's one thing I wanted to touch on before we leave. But I really do believe that for the demographic reasons, for the cash flow, for the appreciation, the tax benefits, multifamily is a great place to be.
So Jake, Maria asks, I'm in the middle of a 5-unit building. I check rentals and every town has a 50 to 60 available rentals. I am getting cold feet. What do you think? So for me, Maria, you really need to know where your market is. Right now in Tennessee, we've had collections of over 90%. March was one of our best months ever. We have 1,500 units. April, same thing. Now, we have properties in Kentucky. So what you really need to do is you really need to understand your local market. Kentucky governor is like, we're not opening till June. Tennessee governor is, we're opening. So that market is opening. So you need to know where you're investing. I live in Florida. I was at Starbucks today. The hotels are open here. Business is going to open down here. So you really need to know on a micro level where you are investing and what's going on with the business climate moving forward. So for us, you need to know on a micro level, at 50, 60 available rentals, there's a lot of supply right now. So for me, I would push out that due diligence another 30 days, another 60 days, check the rent roll, see if those rents are coming in and see if they're able to pay rents. And also in that market, where are their jobs? Do they have a lot of jobs in that market? Is there a plethora of different kinds of jobs? See, where we are in Tennessee, we're lucky. We have the University of Tennessee. We have a manufacturing plant. We have different employers based there. So there's less risk being in that kind of market. So what do you want to jump onto that, Jake? What do you want to add?
No, I think it's a great opportunity though, because you have the opportunity to buy these assets yourself, buy some. We started off with a 25 unit, and I missed the first part of the question, but we can get to that in a second. But I think for everyone on the line is you're in real estate right now. You can go out and buy some of these smaller assets in the beginning, have additional streams of revenue, have that passive income coming in, or you can invest as an LP investor like Al does, has many businesses going on. You can go and invest in syndication. So you have a lot of opportunities there. But Gino, Gino, I missed on the first part of the question. She was asking specifically, what was the first part there?
Oh, so I'm in the middle of a 5-unit building. I checked rentals, and every town has 50 to 60 available rentals. I'm getting cold feet. And
What
then
does
she
that
says,
mean? There's the towns have 50 to 60 available apartments.
yeah, that's what it looks like. So there's a lot. Looks like there's a lot of supply right now.
So you have to look at, but if you go in any like MSA right now and you search apartments, whether it's in apartments.com or Craigslist, there's going to be a slew of ads. And the typical occupancy, maybe in a good market is like 95 to 97%. So there's probably thousands and thousands. I mean, unless you're looking in a very small town, you have to also, when you're looking at these deals, qualify the town. Is there population growth? Is there job growth? And then look at where are these I'm getting a little kickback there. Where are the residents working? That's one of the most important things because you're buying a stream of revenue. And again, someone threw out the term rocket science. Multifamily is not rocket science either. It's going to be income versus expenses. You're going to have to make sure you buy the things correctly, you manage them right, and you put the right debt on them. But once you're going into it, it's not like this totally confusing thing. You got to put good management in place, get the right debt on it, and then service the customer. So I think that just because there's available units, I would maybe dive deeper into a CoStar report and try to understand what's the normal occupancy for the area. Because just because I see available units, I think that's a very subjective measure. I wouldn't look too much into that, but I'd want to see, okay, if I'm buying a 5-unit complex, is there a diverse employment base there, and where are these people working? Because if you're seeing folks that work for Club XYZ, right? We were talking about this the other day, and a construction worker, and somebody at another place where their job is not as stable, you may not be wanting to buy that right now. But if you see firefighters, cops, healthcare workers, that's a very stable stream of revenue right now in this environment. And also, if depending on where it is, if it's in New Jersey or if it's in New York, I would be a little cautious of buying anything in those markets right now, just due to how, I'm going to say this in a most politically correct way, how severe everything has been shut down. Because you don't know where that revenue is going to be or if they even require these folks to pay. Now, from our perspective, we tend to buy stuff that's in more business-friendly environments. And again, guys, not getting political on this, just saying that it's been a strategy of ours because, as Gino was alluding to in Tennessee, we've been able to collect the rents. The money's coming in, and it's and they're reopening. Look, this stuff is hitting different. No one's trying to be able be a scientist and predict the coronavirus or anything right now. I just know that it's when you have the ability to collect and the local authorities allow you to retain your rights as an owner, it makes a big difference. Because if they say, well, you can't evict somebody, they kind of just say, okay, you were taking your rights away for now. If the tenant pays you, great. If they don't, it's on you. So that's a big challenge right now for sure.
Jake, what Maria can do is you can also go on apartments.com and see the amount of apartments that are available in your market, see what the rents are, and I would call a few of those that you see that are listed and see what they're offering, see what their rentals are, see if they're offering concessions, a free month, free application fees, free move-in, whatever that may be. See what they're doing, and you'll get an idea after calling 3 or 4 of them to see if they've lowered their pricing. So that's another strategy that we.
It's different than inventory on a home. If you go into an area and you see that there's a lot of homes for sale, that's a direct relationship to inventory potentially. Just because you see a lot of rentals on, again, 95 to 96, 97%, and some people may be putting their ads up in order to pre-lease. So it's very much different. So I wouldn't.
Jake, the other thing right now, it's a little difficult because most people can't move right now. A lot of residents can't leave because they don't have money to go into another apartment right now. They don't have the cost to move into another apartment because you have to take everything out. You have to get a month's security in the front end and a month's rent. So a lot of them are stuck where they are right now also, especially depending on where their market is. So you have to take a look at that also.
Yeah.
Yeah, I unmuted you in case, did that answer your question or did you have any follow-up questions? And then Andi's asking about syndicated properties. Maria? I think Maria fell asleep.
Maria Bellavia. Nice Italian last name.
Wait a minute. I'm here.
We can hear you.
Can you hear me?
Yes.
Yeah, we can hear you.
Okay. Yes, that did answer my question. However, I am a little bit relieved because all units are rented and everybody paid their rent the last couple of months.
Verify with the bank statement though.
Okay.
Just want to see. I want to see it hit the bank. You just never know. Like like the guy that was on before who's saying he still had a job and he didn't. Trust but verify.
Okay.
And also, May is going to be the tough month. I think we've gotten really well in March and April. I think May 1st is telling because right now I see King Kong is asking that question, how the eviction laws in Florida, Tennessee, and Kentucky are going. Well, right now we can't evict in Kentucky until July 1st. So what is that? What message does that send to your residents? It sends to your residents, I don't have to pay until July 1st. But when July 1st comes, they have to pay. So we are going to probably see a little slippage in May and June in Kentucky. In Tennessee, I don't think that's going to be the case. And the same thing in Florida. Eviction laws are great down here. Jake can go through the eviction process in Tennessee and Kentucky. But down here, people are still unemployed. Construction has been an essential business down here. And there's still a lot of construction continuing to go on down here. So people have been continuing to work. And when they open these restaurants up in the next week, there's going to be people that are working and able to pay down here. So that's been really, really positive for us.
Yeah.
Jake,
There's another piece to it, though, that what you saw, the CARES Act sent the checks out. So you saw a lot of people getting their $1,200 or more
Yes.
stimulus checks this month. That helped. And a lot of people, and for the folks that may not be aware of this, they're calling it unemployment insurance on steroids. So typically, if you're making $200 to $300 a week on unemployment, now it's going to be more like $800 to $900. So people on unemployment will be $40,000 to $45,000. The thing is, no one's got this money yet. So I think it's intentional. Look, I'm not like trying to be a conspiracy theorist or something, but they kind of flushed the money into the market with the stimulus checks this month. And I think you're going to start to see that enhanced unemployment hit next week going into May. And I think that's going to help cover the gap for rents as well. So more to come, but we'll see. So, but I do have a sneaky suspicion that may be intentional. So because they're trying to drag it out here as people stay closed.
Just give them the eviction process in Tennessee if you want. How we do it?
Yeah, so no, it's a 14-day eviction. So on the 6th we can give an eviction notice, and then after 14 days, we're filing it to go to court. So typically, you give the eviction on the 6th. By the 25th you're in, and then however long, and typically they'll leave by that point. So you're seeing like within a 30-day turnaround time. But if they don't, there'll be a set out date, and then hopefully you're out within 35 to 40 days. Which for folks that may be in New York or New Jersey, you're probably saying that's not even possible because it's probably like 90 days or something. But
it's quick. It's very quick down here.
Yeah.
So Andy had questions, I guess, about the advantage of syndication maybe versus doing your own deals.
Right.
Yes, syndication is great. I'll just hit it real quick. Sure. It's a way for you as to basically partner on a deal with someone that is what's called a sponsor or a syndicator. So you're able to shop deals, see what deals that the different syndicators are bringing to the market, and then buy into those deals. And the great thing about it is, if I was ever going to buy a stock, this is a great way to image it. I would want to have a return every month. I would want them to pay me some sort of dividend. So typically with our syndications, it's an 8% preferred return that gets paid out quarterly. So you're seeing actual cash flow from the properties. You're seeing the tax benefits. You're seeing the mortgage pay down. So the similar, the benefits, but you're not having to go out, find the deals, do the due diligence work while you're working your job. So it's a great way to get invested into larger multifamily properties without having to do all the legwork on the front end.
And it's a great way. It's a great way to start investing in multifamily because you get your toe in the water. I say learn while you earn, right? You're learning the process. The hard thing is you have to find a sponsor, someone you know, like, and trust that is doing a deal, someone who has credibility. And then you really have to educate yourself on underwriting these deals, on looking at the markets and looking at multifamily in general. You partner with the sponsor, you're become the limited partner. So you're limited to that risk to that deal. So let's say that deal goes belly up. You're only limited to the amount of money that you put into that deal. Jake and I, as the general partners, we're signing on the debt. So we have a little bit more skin in the game because if we go bad, we're not getting a loan ever again until we make that deal whole. So it's a great first step to get into. A lot of our students start as LPs and then all of a sudden they learn the process and they say, you know what, I like this. I'm going to start raising capital for other people and get into deals that way. So there's another way to do it where you start raising capital and bringing capital to a Jake and Gino group or to another group and saying, I've got people who've got a lot of money. I can start partnering with them. I can start helping them raise capital. And then you can get into the process that way by doing it. So a lot of our students are starting to do that. So, and there's so many different ways to get into multifamily. Like Jake and I, we bought deals ourselves. We didn't start with syndication. We bought our own deals. We bought 1,000 units before we syndicated our first property because we didn't know any better. We didn't know syndication. When we first started, the Jobs Act had come out in 2012. So raising capital was a little bit different. It was a little bit harder to do it. And then when we started, we just said, we love the equity. We love it ourselves. And we had limiting beliefs. So that mindset, right, where we didn't want to take on any investors. We thought it was risky. And we just kept buying deals, refinancing, putting the money back into the deals, and just growing that way. But syndication is just one tool in the toolbox right now. And I think the next 90 days, it may be difficult with the lending parameters coming in. They want a lot of reserves on these deals, but it will come back, just like everything else is going to come back. And what I like about syndication is you can put a little bit of money into each syndication. It's like buying a mutual fund, right? So if you like Jake and Gino one deal, you can put 50,000 in that one. You like another one. So if you want to invest in different markets, different asset classes, if you like office in this place, you like multifamily in that place, you like self-storage there. There's different types of syndications also that you can invest in. So
great. What's your favorite syndication?
Well, listen, I'm partial to multifamily. I think office is going to get hammered because people can work from home. People are more productive from working from home. I think strip malls are going to be hammered unless there's some anchors. But see what happened. I mean, if you don't have a pizzeria, a nail salon, a hair salon,
barbershop,
a barbershop in a strip mall, you don't need to be there. And there's so much supply that you can buy stuff on the internet. Everyone's using Amazon right now. Amazon and Walmart, they're all delivering right now. So people's, I think the book that you need to read really is the book written by, it's called Big Shifts Ahead by Chris Porter. Read the book. We did the podcast with him, and he talks about specifically what you're talking about, people's habits. It goes into demographics, but it goes into the habits. In the 80s generation, why do we have Zipcar? Why do we have Uber? Why do we have Airbnb? This is the sharing generation. It's all about their habits and how they're doing it. Do they want to go to a mall and hang out and buy stuff? Not really. They'd rather be on their phone and buy stuff. And it's the same thing going on with leasing agents and property management. The Gen Z wants to be on the phone. They don't want papers. They want instant gratification. So their habits are changing. So the book really discusses that. So for me, office space, I think a lot of people are going to be smart and say, I don't need to be in New York or New Jersey. I can telecommute. I can come down to the Southeast. I was on the beach this morning, 85 degrees this morning. I'm going to go play tennis at 5 o'clock. So I can do that. I can telecommute. I can go live where I want to. So that's why I love multifamily. And I think office is going to suffer. Self-storage is a weird one for me because I live in Florida now. There's no basements here. So we have no storage. And there's such an abundance of building down here, people moving, that self-storage may work in this market really well. But I don't know when we go into recession or depression, are people going to hold their self-storage units or just shed them because they don't want that extra $200 a month? I don't know that. What else? Retail. I'm not a big retail fan either. I'm not really big into retail. You see what happens. They can go null and void. Who was the restaurant? Cheesecake Factory. I'm not paying my rent. Yep. Cheesecake Factory. If Cheesecake Factory can say that to a landlord, then anybody can say that, right? So everyone's
very irresponsible.
They're the real deal.
You
have all these. Yeah. So I like multifamily. I like multifamily and self-storage down here in the South.
Look at the winners too, Gino. If you look, Amazon is so well positioned right now because they have Whole Foods and everyone's buying everything on Amazon right now. So all the basic stuff that you need, and for everybody on this call right now, you folks are involved in residential real estate. That's a great place to be right now. And that's why, we love multifamily. I think it's great that, you folks are, trading, residential homes. You put the money into, multifamily properties. And I think it's just when times like this come, you're in a position of preservation where a lot of folks, if you're in a hotel or Gino just got out by the skin of his teeth, sold his restaurant in Westchester.
February 24th, I was up in New York here to do the closing. I was up in Putnam County. I flew into JFK. I went and closed the restaurant. I was there for 25 years. So I grew up in the place with my dad. So it was hard, and I don't know how he sold it, and I don't know how that happened. By the grace of God, I have no idea how that happened. I was really blessed. But I think, God gave me the opportunity to work hard and take advantage of that. And I sold it. And if I look back at that right now, we have this slide on mindset right now. For me, my mindset was always a fixed mindset. I had a little growth mindset, but I had a fixed mindset. But when I married my wife, a couple stories, we first got married, and the fixed mindset is one that's, I'm smart. I don't need to do anything. I don't need to get out of my comfort zone. So I married my wife over 20 years ago. We're having our first child, and she says to me, I want to have a home birth. I said, what are you, nuts? The heck is a home birth? She said, I want to have a baby at home. I said, I never even heard of that before. Typically I would have said, no, we're definitely not doing that. I said, you know what? It's your body. It's your mind. Let's do it. 6 kids later, we've had 5 at home. It's been an amazing thing. But between the fixed mindset and the growth mindset, if I had the fixed mindset, I would have said, no, I'm not giving you that opportunity. We're not having the kid at home. But having that growth mindset allowed me to, take that chance and say, you know what, let's try it. Let's do it. And the same thing with homeschooling. She came to me when my first child was 5 years old. My oldest one's 20 now. She says, I want to homeschool. I said, homeschool? What are you talking about? These kids are going to be social idiots. And it's the farthest thing from the truth. Having the growth mindset and allowing her to do that. My daughter's a junior in college. My son is a senior in high school. He's dual enrolling. So not to say that one is better than the other, because now all of a sudden I was a social idiot 20 years ago, and now we're all homeschooling by default, huh? So I did something right 20 years ago, right? Which is pretty funny. But the moral of the story is just to have that growth mindset, have the ability to confront challenges and have the ability to pivot. Be open. Fixed mindset is the one that doesn't want to grow, doesn't want to get out of their comfort zone. And the growth mindset is commit, and then we'll figure it out. And look at those challenges. We're going through a lot of problems right now. But from these problems, we've gotten a lot of opportunities. Jake can talk about the property management and the virtual tours and the over communication and just the way that we've been able to hire some amazing people during these down times and the ability for us to work on our systems. So that mindset is really important.
Yeah, I think to piggyback off the mindset as well, Gino, is that it's our most powerful asset. And I challenge everyone to be honest with themselves right now. How many of you are focused on your business right now, focused on your family 100%, and not getting stuck on the media merry-go-round? Because it's something that, if we're being honest with ourselves, I've been guilty of it. It's embarrassing to say it, but we can get trapped in this media BS that's going around pulling us in. And who's the winner at the end of the day? Who's the one that's self-serving? The more eyeballs they get, the more we stay on the merry-go-round, the less we're working on ourselves, our business, and our families. And that's not where you want to be. And that's why I'm challenging everyone right now. Get off the damn merry-go-round. Focus on your family. Focus on your customers. Focus on your business. Because the folks that are going to come out of this, winners, are the ones that have put the time in and put the work in. And I applaud everyone right now, because everyone here is on the call. They're expanding their mind. They have a growth mindset. And that's where you need to be. The folks that get stuck on this stupid trap, and it's self-serving to the media, because at the end of the day, the media is getting eyeballs, they're getting advertisers, and they're making money. Get off the damn merry-go-round and work on yourselves right now, and you're going to come out ahead, because I'm telling you right now, they're not going to quit until we reject it. Look, I understand there's some crazy stuff going on right now, and we need to educate ourselves, and we need to know about it. Al's gone through it. It's not like it doesn't exist. I'm not saying it's not real, but if we get stuck on this merry-go-round, we're going to be hurting ourselves, and we're not going to be providing for our families. So that's the thing I want to get crystal clear with everyone right now. The opportunities are going to be there. There's going to be folks that are leaving the dense areas. All you folks stand to profit from that and serve these customers. So I just challenge everyone, get off of it the best you can, because it's not helping you anymore.
And Jake, one of the best ways to get a growth mindset is to find a partner who has a growth mindset. So I was fortunate. I was stuck in the restaurant back in 07, 08. My big pandemic was the Great Recession. It really opened up my mind. I had 4 kids. I'm like, I hate doing what I'm doing right now. I grew up with my dad in the kitchen. I loved cooking. I loved working. But when that came in 08, everything changed for me. I'm like, I don't want to deliver food. I make a good pizza. These guys, Domino's and this crap is coming and competing with me, and I needed to change. And I'm thankful that I found Jake, because that accountability piece, being part of a team that you guys have, really allows me. Because you know what? When we got to do a podcast, I can't make an excuse and go, Jake, I can't make the podcast, because I will tell you, I will do more for him than I will do for myself. And I wake up every day having a team and having the growth mindset of saying, I've got to get better every day, not for myself, for everybody that I'm serving, whether it's my family, whether it's my children, whether it's Jake, whether it's my boy Josh. That's who I have to focus on. So you have to stop feeling sorry for yourselves, because the fixed mindset tells you you're a victim. You're feeling sorry for yourselves. And those who really prosper in life, just take a look around. We're all responsible for ourselves. We're responsible for our actions. And when I read the book from T. Harv Eker, Secrets of the Millionaire Mind, I read it like 10 years ago. I took it personally. I'm like, this guy's a jerk. I mean, what's he talking? He doesn't know me. But then when I dove down deep, I'm like, wow, this guy is so right. Just read that book. It's like we all have a financial thermostat, and mine was set to thousands. And then, how do I have one restaurant in 25 years, and within 5 years I have 1,500 apartment units? I didn't get any smarter. I don't think I did I, Jake? It was just about my mindset. It was about expanding myself and challenging myself. I was watching a YouTube video. I shared it with Jake. I should share it with you all. Just email me, gino@jakeandgino.com. I'll share it with you. And it talks about our subconscious mind versus our conscious mind and our programming. And it really hit me because I look back at my mental blueprint that I had when I was growing up. I had two great parents, but they were immigrants. That's why I worked my ass off, because my first 7 years of my life, my dad was always working. He was saving money. I don't want to call them cheap, but I want to call them frugal. That's why I'm not driving a Ferrari right now. You know, that was my blueprint. So I was living in the subconscious. Our conscious mind is right now when we're live, when we're living, when we're creative, and we only live that throughout 5 or 6% of the day. So if you can get around people who are just as educated, just as smart as you, and just as excited as you are, you're going to live your conscious mind, and you will get out of that comfort zone. And that's what Jake allowed me to do for the last 6 or 7 years. I've been able to grow more. I've been able to think outside the box, and I've been able to connect with other like-minded people. And that's how you're going to grow your mindset, by working with those people out there and finding those people.
Amen, Gino.
Amen.
So, look, we don't have a crystal ball, but we want to talk about the future because we can't be stuck in the present. We need to look, to future growth and what does the future hold for us. Now, again, I think there's going to be opportunities in multifamily. I especially want everyone, on the call to keep a lookout for what we call mom and pop deals. We're talking about smaller deals, 2, 4, 6, 8, 10, 15 units. Again, Gino and I started with a 25 unit deal. I think the folks that are burnout, that are not good managers, that maybe go through the whole COVID and have, people that are not paying them, folks, we're going to get through this. But if you see some people that do not manage right, we talk about buy right, manage right, and finance right. I think multifamily investing is a 3-legged stool, and I think it comes down to those 3 parameters. There's going to be deals to head. I do think it's going to be in the smaller unit counts. So, keep an eye out for that. And there's multiple ways to get into multifamily. Maybe you know someone that is a multifamily operator already and you bring them that deal. There's value in that. That's one way to get in, and maybe you get a piece of the deal that way. Maybe you find a syndicator that's doing a deal and you put some money in that way. I think there's going to be opportunities. I do think these larger multifamily assets, though, as we come out of July and in the late summer, I think there's going to be even more demand, though, because look, people are feeling burnt on the stock market every day. One day it's futures are up, futures are down. Oil's this, oil is that. And look, no one wants to live like that. You want something that is steady, that produces cash flow for you month in and month out. So we're going to continue to look for deals that align, with our framework, the buy right, manage right, and finance right. And that's what we're doing right now. So again, short term, it may be challenging, but this is your opportunity to identify those golden nuggets. So as we start to pull out of this, you're going to be the one capitalizing on those deals.
Jake, I forgot to mention, here's the book, Mindset by Carol Dweck. I would tell everyone to read this book because it was amazing. Because, raising my kids and educating my kids, I didn't want them to have the fixed mindset. I didn't want to tell my kids they were smart, because if you tell somebody they're smart, then when they go try to do something in the real world, they're like, I'm not that smart at doing this. I'm not going to try it. I want to tell my kids to work hard. And that's what I forgot to say in the last segment, working hard. And it's okay if you came in 3rd place. You're not number 1. If you want to be number 1, you've got to work a little bit harder. Let's not diminish the person who won, because that's what you're doing. You're diminishing their hard work and their hard effort, and they have to work really hard to get there. So I just love that book for so many different reasons. And this is something we should be reading right now, because right now, if we're stuck inside, the author is Carol Dweck, D-W-E-C-K. If you're stuck inside and you're, like Jake said, you're watching the TV, you're scrolling through Facebook, there's a lot of crap on there right now, and it will affect your mindset. And, the placebo effect is true. If you believe in positive and you believe in great stuff, it's going to happen. It will happen. If you have the nocebo effect, the negative works just as powerful as the positive. So that's why you're reading the book. I think you'll get a lot of different ideas on how to actually tap into your mind.
Gino, I always say to my wife, it might sound a little harsh, but I say, don't confuse effort with results. And I think everybody on the line right now, when was the last time someone paid you a commission for trying hard? I don't think it happened. You had to get the ball over the line, and that's the challenge in life.
Dude, that was the story of my life at the restaurant. I mean, I was working 12-hour days. I mean, really? It would snow. I wouldn't get paid that week. The next week, the power would go out. The next week, something else happened. It was every week, and the effort was there, but the results weren't there. So that really hit me, bro.
And it's another reason we love multifamily, because multifamily owners get paid in their sleep, day in and day out.
King Kong asks, are you holding the assets for long-term or exit
Gino, do you
out?
keep saying King Kong?
No, that's his name. So I love the name. So King Khan.
Oh, I'm sorry. I
K-A-K.
thought you were
That's all right.
because you said something earlier, and I thought he said
No,
King
no,
Kong. I'm sorry about that, guys.
It's okay. He says, are you holding the assets for long-term or exit out 4 to 7 years? Do you see deals in multifamily or in senior living? So, I mean, we're holding our assets typically 5 to 7 year hold, but what we're going to do is I think Q3, we're going to start a fund because we want to start holding assets long-term, because we podcasted a gentleman named Sam Freshman. He's in his 80s. He's been doing syndication for 50 years. And his biggest regret, his biggest mistake was selling. That's what he said. He's been holding these things for 50 years. So I'm like, dude, I want to hold these things for long term, but it's hard to get the average investor out there to say, give us your money. We're going to be in with you. We're going to return all your capital. Then we're going to continue to hold these things, pay down the principal. And it's going to be like an annuity. It's going to be paying you out. The average investor wants their money, bing, bing, bang. And the average syndicator doesn't want to hold them long term because their idea is to hold it for 3 years, sell it, and split the profits on the back end. Nothing wrong with that. And then go for the next deal, go for the next acquisition. So there may not be an alignment of goals, right? So for us right now, our deals right now, we want to sell one. We're actually going to put a couple assets up for sale before the COVID crisis hit. So we're still going to sell them once everything levels off. But I think in Q3, we're going to start a fund, and we want to hold these assets long-term because we know this is where we want to be. And it deals in senior living. Senior living is a different kind of animal. I mean, there's so many more moving parts, but unfortunately,
management intensive. You want to talk about management intensive? That would be the kind of thing if for even so, we do syndications ourselves. I'm not going to do a senior living deal myself. That is 100% one I would syndicate. It's hard enough to put a multifamily deal together. If you're talking about nurses and doing all that, that's something I would invest in as a
Jake, at the
LP.
same time, it's big shifts ahead. It's the demographics.
No, I'm not saying there's not value. I just don't want to manage it.
Yep, huge.
So it's interesting too, because we've only sold one of our apartment complexes, and it was a smaller one, and it was just, there was too much equity built into it, and we could use it for bigger deals. And literally we bought it for 37 a door and we sold it for 103. But our core assets, I just want to hold these things forever because they pay us every month. Tenants are paying rent. We're keeping up with the properties. And it's just, it's the kind of thing where why would you kill the golden goose? They're so hard to find these good deals the way it is. And if they're performing, I ultimately want to hold these things for as long as humanly possible.
Some people might not be familiar. I don't know if you can share it, but like, what do you typically see in the deals? What's a return on some of the deals that you do that people would expect? I don't know if it's IRR.
So here's the interesting thing, Al. The deals that we've had for probably 5 years or more, all of those deals are all an infinite return because we've already refinanced those and got all of our initial principal back. So that's our initial capital that we put in, which is amazing. What we're shooting for on the front end on actuals is an 8% preferred return for the syndicated deals. So an 8% quarterly distribution.
Got it. And then I don't know if you can add, what is it, when you exit the deal and you factor that in, what does that annual rate of return wind up being?
So
go ahead.
I was going to say, an IRR, you're looking between 15 and 20. That's what you're looking for. But it depends right now. Like I said, if we're looking at a deal, we bought the deal in November of 18, our first syndication. We paid $6 million. We were ready to sell it for $9.5 million 18 months later. I mean, it was an amazing turnaround. It was just a mom and pop. So that deal is going to be, in the 40s IRR. But if you tell it to an investor, they're not going to believe you. So, we're looking between 15 and 20. And the reason why we underwrite 250 to 300 deals a year, we only bought 2 deals last year. So it's not like we're popping off hundreds of deals. We're being very, 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 very selective on these deals. And they're harder to find. I think now in the next 6 months, we're going to see some more deals come out. And, hopefully the financing gets a little bit easier. We might have to do some owner financing on some of these deals also. So that's coming back. Owner financing is going to be awesome in the next 6 to 12 months. So I'm looking
that's the other thing I forgot to mention, you guys. I told anybody who's on this call, they could just send you deals and you do all the work and underwrite them for them and just tell them if it's a good deal or not.
Let them send it over to me. I have Mikey T that can take a look at it for sure.
Cool.
And that's why I like the long-term hold, because these things are hard to find the way it is. So it's hard to find these. And if you let the deal work itself through and you pay down the mortgage, look, it may be 30 years before the whole thing gets paid down, but it pays you every month. You're building generational wealth, and you're really leaving your kids with something significant and for future generations. And that's been a huge motivating factor for myself, and that's essentially what we're looking to do. So.
Jake, on this slide right here for deals, I just wanted to mention to everybody how we try to analyze a deal. And it's hard to say, is a deal because every deal is unique. But
it's up to you. And that's on the person buying the deal too. So if you came to me and said, is this a good deal? I'd have to understand more of what your parameters are. What kind of cash on cash return are you looking for? What are you comfortable with a cap rate? What do you like about the city? Do you feel comfortable with the job and population growth and the employer base? These are all things that we need to be asking ourselves, and that's what goes back to the parameters. Sorry to interrupt there, Gino, but that's when we look for when we say buy right. It's setting your parameters on the front end, and what are you looking for in terms of a cash on cash return, cap rate? What are you looking for from a market? And we try to set those parameters up on the front end to meet your objectives.
Hey guys, can I jump in for 1 second?
Of course.
Yeah.
This is scheduled to go at least until 4. I have a doctor's appointment. I have to jump off early. Colleen is on the call who kind of co-host it with you. But Colleen, if you can.
An hour goes quick, Al.
It's an hour already. Holy crap.
But and Jake and Gino said they could stay at latest till 6:30 or 7.
Yeah, no, my wife will bring dinner in for me. It happens all the time. So.
But Colleen, if you can make sure, just a lot of people want to know how to contact Jake and Gino, and if you guys want to talk about, they do syndications, but they also have a coaching business. A lot of different ways that you can interact with Jake and Gino. And I actually am a coaching client as well, and it's been very helpful for me. So thank you, Jake and Gino. Keep going as long as you
stay healthy, Al. We'll keep rocking here.
Yeah. And Kat, can you, if Jake and Gino, if you tell us how to contact you, your email, Kat can put it in the chat box.
Yeah, so and I think the easiest way too is at jakeandgino.com/honeybee. We actually have free resources there as well, and with our credibility book. The credibility book was a business blueprint. It was something that we started early on, and we give that for free there.
So if anybody emails me, I will send them a PDF copy free of the Honeybee also. It's this book right here that I was mentioning before. So just shoot me an email. Give me a few minutes because after this call, I've got another call at 4:30. But I'll send something over by the end of the day. But what I wanted to mention here about the deals, this is really relevant to all of you, especially in the residential space. When we're looking at a deal, we call it the 3 pillars of real estate. Now, the 3 pillars are really important. The first one is the market cycle. Now, you can Google market cycle, figure out where we are in the market cycle. But right now, we were at a seller's market cycle. And 30 days later, we flipped the switch. We're at a buyer's market right now. So completely different flip. So you have to know where you're in the market cycle. The second one is the debt. What kind of debt are you putting on these deals? Really important for us. Are we putting long-term fixed rate financing so we can ride through the wave, ride through the recession? Are we getting bridge financing? Are we getting seller financing? The financing is really, the debt is really important. And the third one is the exit strategy. That question from King Khan. What are you doing? Are you holding these things short-term? Are you holding these things long-term? Are you flipping them out real quick? Are you assigning the deal? What is the exit strategy? So you have to couple all 3 of those and look at it holistically and see what happens between, and look at it from a residential perspective too. If you're buying a duplex, are you going to hold that thing for long-term? Are you going to get long-term fixed rate financing? Are you going to refi that thing out? Are you going to sell it 3 years from now? That will affect a lot of different things. Because if you're holding it short-term, you don't mind paying 15% on your debt because you're going to flip it out in 3 months and make a ton of money. That wouldn't make sense if you're holding a long-term. You're going to go for long-term fixed rate financing. So look at those 3 pillars. It's market cycle, debt, and then exit strategy.
Yeah, and anyone that's looking at a deal right now, the management piece is going to come down to, really be where the rubber hits the road. That's what I'm saying. If you're looking at a deal right now, you're buying an apartment deal, check the bank statements. Make sure what they're reporting is actually hitting the bank statements, because once you buy it, it's going to be on you. So you want to see if they're reporting that they're collecting $2,000 a month on, a duplex, $1,000 for each unit. Make sure you see a copy of that bank statement that those are hitting right now, because that's where the risk is going to come in at this part of the cycle, because people are losing their jobs and they're going to struggle to make payments. I do hope that the unemployment, that they said unemployment on steroids starts to hit in May to help us weather this storm. I think that's going to be a huge component of it. But look, people need to pull it through. So excellent management is going to be key right now. And it's that trust but verify that we're going to have to see.
So Jake, on the manage right, we're doing a couple things. We're doing virtual tours now. We never thought of doing virtual tours because our offices are closed, but since we're an essential business, our leasing agents are in the office. So we're doing virtual tours, and it's worked really well. I mean, people like it. I think it's a great technology piece. You still need a leasing agent. You still want that hand-to-hand holding. You still want that closing. But if a tenant can go out and self-qualify and look at it and do a virtual tour and then come in and say, hey, I like the unit, it's really, really key to what's going on. Let's utilize technology. And the other piece was we're using Tenant Turner. We're using artificial artificial AI, artificial intelligence, to actually get these leases going. It's amazing that, you know, they start calling into the office, they get in with this artificial intelligence, and the tenant prospective prospect is texting with the artificial intelligence, and they think it's a real person. That's how awesome it is. You're not even talking. And then that artificial intelligence books the schedule on the leasing agent's calendar, and there's no touch point. And it's just amazing and seamless how AI and how that's going to start taking over multifamily. It's going to be, it's really, for us, it's really exciting, because all those lost leases from not getting that touch point, AI is taking control of that for us.
Yeah, and the final piece is the finance rate component. You know, we look for what we call agency debt, which is going to be your Fannie and Freddie. That is non-recourse. So, say heaven forbid, you know, something happened to the economy in that area, people couldn't pay rent. Essentially, you're able to, you know, give the property back without personal recourse. Right now, though, and we've used community banks, you know, local and regional banks as well for some of our deals. And I think right now is going to be a time where they start to, you know, become more important again, because what you're seeing is what I mentioned before, is that the agencies, Fannie and Freddie, are requiring an additional 12 months of principal and interest to be brought to the table and held in escrow when you're buying these deals. So that means you're having to bring more cash to the table. So people may be willing to do a recourse deal with a community bank right now to buy an apartment complex versus going with Fannie and Freddie, because it's going to be easier to get financed. And look, I don't know how it's going to apply to your world. I know everyone was talking earlier about, you know, getting some of your residential deals financed, but I would, you know, challenge everyone to have relationships with local community banks, because they will finance deals that sometimes the agencies and the folks that are, you know, going to make it more challenging to get them over the line will. So we look to, you know, these local banks as partners at times. So don't count them out, I guess, is the key. Now, again, we were, you know, touching before on how we're a vertically integrated group. We have in-house, you know, mortgage, we have in-house syndications, in-house property management, the education, and the media. Now, I think that the thing that's very comforting right now for our limited partners, the folks that invest with us, is that we're controlling the entire process. So if we need to reduce expenses, you know, we've cut down on lawn care, for example, right now. We've cut down on the pest control treatments. We're only doing essential services for the business if it's an emergency call, if there's a water leak, if someone's heat is out, if their stove isn't working, if the refrigerator is busted. We're doing everything we can because we know that this is a more challenging time. Fortunately, we've collected almost all the rents that were due to us for this past month. Look, we still have to get through May. I think, you know, going into June is going to be a different story. We're not, you know, through the storm yet, but you know, we're definitely performing. And I think, you know, part of that was our vertical integration and being able to, you know, control the whole process, you know, down to the management level.
So Jake, on this slide, we talked, me and you, about creating core values and a mission statement. And for us, it was really important. I think everybody out there should really think about this, whether you're working with another company, whether you're working by yourself, create some core values for yourself, because they will guide everything you do. I mean, our core values are people first, you know, make it happen, growth mindset, unwavering ethics, extreme ownership. Those are our core values. And that has really guided us and helped us from the hiring process, whether it's a vendor, whether it's an employee. Those are really, really important. And we've just been focusing on these for the last 18 months. I wish we had them sooner, right? We have our mission statement, which really guides our principles. And, you know, all these different companies, they work together in a great relationship, whether it's our education company that services our students, whether it's our multifamily property management, which services our residents, whether it's our syndication company, which services our investors. For everyone right now, if we're stuck at home, we have a few more weeks to work on ourselves and work on our businesses. Let's start thinking about what we want our core values to be. Let's start living our core values, and let's start, you know, hiring and firing based on those core values.
Okay, we'll wrap it up here in just a second. But, you know, the final, you know, piece to why we're really loving multifamily right now is that, you know, the government has stepped in, and there's something, you know, you may have seen the PPP. You know, we have actually been very fortunate. We're not going to have payroll expense for the next 2.5 months, essentially, because we were able to qualify for PPP. So we're, holding that money back, using it for our payroll. We have, 60 employees, and that's been, super helpful right now to give us the confidence, over these next few months that, everything's going to remain stable. So when you are, essential need to the economy, you see that the government is acting. So it just gives you even more confidence to be in this space. Also, there's something called loss of rents, or maybe you've heard of business interruption insurance. We've been speaking closely with our insurance brokers as well, and they're saying that there's a possibility that if we do experience by the end of April any unpaid rents, from that we can prove that the residents lost their job or what have you, that they said they're saying to file for the loss of rents insurance. Now, he's saying right now that the insurance companies are saying no, but there's been rumors that they think the government's going to step in there as well and cover the gap. Who knows? I'm not saying they will. I've just had conversations about this, but if that happens, it gives the industry that much more stability and makes you feel good about being in this space.
And Jake, before we wrap everything up, there's just one important thing that I like to mention, that when this all started, having the growth mindset of not freaking out. There was a lot of gurus out there. I don't want to name names, Grant Cardone. All of a sudden, the next day he comes out, he's firing everybody. Everyone's going off the thing. And Jake and I sat there. We have 60 employees. We actually implemented health insurance May 1st. We're starting health insurance for our entire team May 1st, in the middle of it. If I had the fixed mindset, I would have freaked out. I already did freak out, but I would have really freaked out. Said, no health insurance. I'm firing everybody. But we took a step back. And one of the reasons is because I have an amazing partner, because we actually sat down, worked together and said, how can we work through this? What can we do not to fire anybody? We're not going to get paid. We're not going to take any draws on the properties. We're not going to do any of this stuff. And living through our core values and actually just sitting back and reflecting and not overreacting on the situation actually saved us. And then all of a sudden PPP comes out and EIDLA comes out, all these different programs come out. And if we had overreacted, we would have fired a lot of really good people, and we were able actually,
and we would have lost trust with them, Gino, more importantly, because they're great team members.
Yeah. So I mean, the lesson that I learned in this story and what's been going on in this crisis for us is things happen. I mean, really bad things happen, but maybe sometimes just take a step back. And from that problem, that we created a great opportunity. And now a lot of our employees are actually thanking us. I mean, the emails that they're sending Jake are just awesome. Thanks for keeping us on. You have a lot of, the weight of your shoulders, and, we have a lot of trust, and a lot of our team members are actually working harder, and they're helping us through the situation. So that trust has been great. And I guess the moral of the story is try not to overreact. Try just to sit down and figure things out and work through them.
Yeah, and the key to this slide here is that it only takes one. It takes that one deal to get you started in the multifamily space, to start the snowball to roll. It may be little in the beginning. You may be seeing, just a couple $100 a month coming in on your owner draws. But if you keep committing and coming back to it, it starts to build up very quickly over time. And this is the kind of income that you want. It's going to be, passive. You're going to be building up additional income. And for myself, I thought I was going to continue working as a pharma rep and just being a multifamily investor. But what happened was, within a few years, the multifamily income outpaced the pharmaceutical income, and it was actually I was hurting myself by staying in the pharmaceutical job because I could keep pouring, my time and energy into multifamily, which was outpacing the pharma stuff, and it really opened my eyes. And so, look, I'm not saying like everyone has different paths and we go different ways, but if you can find ways to put a little bit of money aside and start investing in these deals. Start with one, start to grow the portfolio, start the snowball rolling, and give yourself that increased freedom and economic security, because you guys are already in the business. You're in real estate. You understand this at a very high level. I'm sure all of you do. It's just taking the action. You understand it. I always say education times action will equal your results. That's the success formula for multifamily. It's that action piece that's next to jump in. So I think it's crucial that once you understand it, once you've educated yourself, the next step is taking action.
And it's funny for me, I'm thinking about it only takes one. It only took one for me to leave the restaurant, to leave New York, and to come down to Florida and to start Jake and Gino. It only took one deal, our third deal. And if I hadn't done that, I probably wouldn't be here right now. So for me, ultimately having clarity on your life and becoming crystal clear on what you want and why you want it. And then it took me to life coaching school. So everyone out there, if you want some personal development, go out and Google life coaching. That ultimately changed my life. Talk about not knowing what I wanted. I wasn't focusing on what I wanted. I was complaining. And for me, the clarity that it brought me, and just all the skills and the empowering questions and all that stuff really, really helped me out. And it just gave me the ability to, when I did find a partner like Jake, I took that leap. Maybe 10 years ago I wouldn't have, but when I met him, I'm like, dude, we got to do this together. So for me, coaching was immense.
Quick little story. That bottom left unit was the first apartment that I had when I moved to Tennessee. 3 years later, we were bidding on that deal. It was 300 units. So unfortunately, we didn't pony up enough to buy it. But I remember the leasing agent saying, "Don't you look familiar to me?" And I said, "Yeah, I used to live in 201." She said, "Oh, what the hell are you doing here?"
Yeah, that's awesome.
But hey, gang, it's been so much fun. Again, if you want the free copies of the credibility book or the book, go to jakeandgino.com /honeybee. And we have some great videos and resources over there. Or you can check us out. Our podcasts are there. We have 4 different shows, as Gino alluded to, and I would love to connect. So, everybody, thank you so much. Colleen,
Thank you.
appreciate you.
You guys were just amazing. I'm sure everybody appreciated you. Thank you so much.
My pleasure.
All right, gang. Have a great day. See you, gang.
Bye, everybody.